Let's start in East Africa, where Uganda has recorded an increase in coffee exports this season to about 3 million bags, marginally higher than the 2.9 million bags produced last year. But Ugandan farmers from the Mount Elgon region, where most of the coffee is grown, are concerned at the deteriorating quality of the region's beans. They fear that this will mean lower prices for Africa's second largest coffee exporter after Ethiopia. CCTV's Isabel Nakiria brings us that story from eastern Uganda.
He has been growing coffee for the last 50 years and depends on the crop for income to raise his children and grandchildren. 82-year-old Enoch Musumbi expects to produce over 1,000 kilograms from this plantation next season, but says a kilogram of raw coffee goes at just 4,000 Uganda shillings, about $1.6 US. This is down sharply from around $4 US a kilogram few years ago.
Coffee takes a lot of money in labor. But if you compare the money you get, you cannot even get enough money to sustain your home, educating the children.
The Mount Elgon region is widely known for its favorable climate, good for crops like coffee, with some of the best yields in the country coming from this region. But most of the coffee is sold in raw form, meaning farmers cannot earn the maximum profit from the crop. Uganda is among the top producing coffee countries in the world, but farmers say this trend could change if government does not regulate harvesting and drying processes. Some farmers dry coffee on the bare ground, making the beans susceptible to dust and compromising the quality.
When we are pulping the coffee, we are supposed to have properly red cherries. Now, if we are going to harvest with these greens, that means these ones are not yet ripe. Now, this is already wrong.
Despite these complaints, the Uganda Coffee Authority says the country's exports this season were remarkable. The country sold nearly 400,000 bags in May, up 56% since January. But coffee is Uganda's major export crop, and farmers here fear that if the quality of coffee is not taken seriously, then it will create a negative image of the country in the world market.
We have never caught up real how to make and keep quality of coffee. That would be the responsibility of UCDA, which is a channel, which is an agency of government, which is supposed to do that, by the way. Getting people to pick the coffee well without picking the unripe ones. Secondly, pulping it well, and then washing and also drying it in the proper way.
Ugandan farmers also now want their coffee roasted and sold through cooperative unions so they can take exports directly to the international market on a larger scale than currently possible. Isabel Nakiria, CCTV, Mount Elgon region, eastern Uganda.
Also on the continent, Nigeria is planning to launch its first Islamic bond in the country's cocoa-producing Osun state, starting with a 10 billion naira, that's roughly $62 million, issue before the end of July. Now, that planned 7-year paper will be the first Islamic bond to be issued in Africa's second largest economy, and it's essentially part of a 60 billion naira debt-raising program by Osun State, which started last year. With the details, here's CCTV's Trevor Mbija.
Hassan Usman, the acting managing director at Jaiz Bank, says that a Sukuk bond has more benefits compared to conventional bonds. The Islamic bank, which started operating in Nigeria last year, has spread out to 10 branches and more than doubled its 10 billion naira investment in the country.
In terms of benefit, Sukuk is a more disciplined instrument than a bond. What I mean is that a bond can be issued by the government to even finance its deficit. It can be done for revenue expenditure, any kind of expenditure. And there is not an underlying transaction for a bond. But a Sukuk has to have an underlying physical transaction.
At an Islamic banking conference held in Nigeria's capital, Abuja, the director at the International Institute of Islamic Banking and Finance at Bayero University, Shehu Usman Aliyu, emphasized the importance of Islamic banking.
The need for financing at zero interest is unimaginable. It's not obtainable in any of the conventional banking. But a form of an arrangement where profit and loss sharing is accepted between the bank and the customer could be ideal for resource mobilization, for resource utilization, and for generation of more employment opportunities.
About half of Nigeria's 160 million population are of the Islamic faith. It is also home to one of Africa's fastest growing consumer and corporate banking sectors.
I feel that Nigeria can be able to leverage on Sukuk, in building infrastructure, since we have deficits in our government process. So we would want government to look at a situation where the private sector will come in, every individual will come in, because in Islamic Sukuk it means everybody is involved.
The Osun bond will be issued through a book-building process which will earn a return for Sukuk holders through a semi-annual payment. This is targeting local pension funds and international investors alike. Local credit rating agency Agasto & Company has assigned an A rating to the note, which will be listed on Nigeria's stock exchange. That's according to a banking source that spoke to Reuters, and the funds will be used to finance construction of education projects. Trevor Ombija, CCTV.
Now let's move on to the biggest story on the continent so far. Analysts are viewing the ouster of Mohamed Morsi from power in Egypt as possibly the best thing to happen to the Egyptian economy since the revolution in 2011. The argument here being that it might help this beleaguered and anemic economy to escape a downward spiral of currency weakness, capital flight and crumbling state finances. Key among the events driving this optimism among many businessmen and economists is the hope for the appointment of a more technocratic administration that would potentially address these problems in a methodical and steady manner while luring back some of the investors and the money that has fled the country. Many observers blame much of the economic turmoil under Morsi, whose Muslim Brotherhood was essentially new to power, as a result of indecisive and inexpert administration. After the 2011 unrest, successive governments had trouble attracting experienced technocrats who feared being tainted by an unpopular ruling military council or by the Islamist ideology of the Muslim Brotherhood. So then, in effect, if Egypt's economy were a patient, it would be quite effectively in the intensive care unit. Following the event of the 3rd of July, the question right now is how to get that patient back onto the recovery path. To answer that question, I'm now joined by Ahmed Abdel Nabi, an advisor to Egypt's finance ministry, and CCTV's Miriam Bemard, who's live in London. Mr. Nabi, thank you very much for your time this evening. Let's start with the problem with the Morsi administration. They've been criticized for not making the hard decisions required to get Egypt's economy back on track. Will the interim administration, however, make those hard choices?
I think the new Egyptian government couldn't make any or take any hard decision or policy. It will be a government to do some policy, not in the hard, but I think they will share their decision with the people, and the hard policy will take after the parliament. But until that, I don't think any government will take any policy or hard policy. It will be some difficult times to anyone to take such that policy.
Indeed. Miriam, over in London, yields on Egypt's foreign debt essentially dropped yet again for the second straight day. What's sparking that confidence signal from the markets?
Well, Rama, the common consensus is that investors believe Egypt's new leadership will boost confidence in the country's markets and open the gates to new economic aid, especially from Arab countries. The government will have some time to reverse the downturn and introduce new incentives for foreign investors. On the political front, it's been a relatively smoother transition, without that intense bloodshed, without a civil war, and that's prompting investors to sustain confidence that Egypt will form a government soon. A major barometer of confidence for any new government will be a potential crunch point when the new government needs to make large foreign currency debt repayments, or if it attempts to cut public spending that could tip market confidence.
Indeed. Mr. Nabi, coming back to you over in Cairo, crude oil futures surged today upon the announcement of a state of emergency in 2 provinces. What's the effect of that declaration of the state of emergency on maritime transport through the Suez Canal?
No. Of course, the Suez Canal is a red line. All Egyptian people, all the parties, Muslims, anyone knows that Suez Canal is a red line, and the Egyptian army guard it very well. Nothing can make Suez Canal unsafe. It is absolutely couldn't happen, and it will be safe. What can happen in Egypt? Canal Suez, it's red line. All people know that, and still will be safe. And the Egyptian army guard it very, very well.
Indeed. Miriam, coming to you. Let's talk about language very briefly. The US and the EU both studiously avoiding describing what's happened in Egypt as a coup. What are the political and economic factors behind the choice of words being used in Western capitals?
Well, I mean, you know, there's mixed reactions among world leaders, mostly because they're unsure who will form the government. You know, we have to bear in mind, if this event was called a military coup, it would put in question the relationship between Egypt and its trading partners moving forward. That's why both the US and EU have shied away from calling it a coup, but also urging a quick return to an elected civil government. You know, the longer it takes for this to happen, the more complicated it can become. At the same time, Europe has taken a much tougher stance on how Mohamed Morsi was removed. In the case of the US, Egypt is a key regional US ally, which also, of course, gets about $1.3 billion in military aid annually. Just last year, they adopted a new joint US-Egypt trade agreement, which included the US working with Egypt's private sector.
Indeed. We'll have to leave it there for the time being, though. Thank you so much for your time, Mr. Ahmed Abdel Abi over in Cairo and Miriam Bamad in London. Thank you for your time this evening. Time for a short break here on Africa Live. Here's what's coming up next. We'll be talking about reforming Kenya's tax code. We'll focus on the country's controversial VAT bill and the state of East Africa's largest economy. See you in 2.
BizAsia. Asia means business.
Welcome back. India has called for deeper trade ties between countries in the Indian Ocean region as global trade patterns shift in the East's favour. While addressing the first economic conference of the Indian Ocean REM Association for Regional Cooperation in Port Louis in Mauritius, India's Trade Minister Anand Sharma also expressed quite a bit of concern over the fact that despite the establishment of a working group on trade and investment, not much progress has been made towards reducing barriers to business cooperation among the countries in the region. He noted that the region's potential so far has largely remained untapped.
But there is also a paradigm shift, you rightly said, that is taking place. It's no more the north-west axis. The shift has taken place in the rebalancing of the global economy. And our efforts have to connect with that rebalancing, with the growth is shifting to Asia-Pacific region, to Africa, and even to South Americas. And in the coming decades, that is where much of the growth will take place, and rightly so, because the majority of the world's people live in these regions. But our combined trade and also the GDP is 6.7, I was looking at the numbers, projected to be very soon 9 trillion.
Now this week, East Africa's biggest economy is smack in the middle of a long-delayed and heated debate about a new law which aims to reform its administration of value-added tax. The VAT Bill of 2013 was initially proposed about 2 years ago by the then Finance Minister, Uhuru Muigai Kenyatta, with a view to cutting an extensive and disorderly list of exempt goods and services while raising an estimated $58 million in tax revenue. However, its successor bills have all run into fierce opposition for reimposing VAT on some staple commodities like maize flour and bread, among others. Late on Wednesday this week, the presidency backtracked on some of those proposals, saying it would keep maize flour and bread VAT exempt. Now, Kenya's government, to put this into context, has been grappling with demands for public sector wages over the last couple of weeks, with the majority teachers' union currently being on strike. It has also come under quite a bit of public criticism for planned extravagant expenditure. That includes $1 million renovation of the official residence of the deputy president, which was completed in late 2012 and is yet to be formally occupied. Let's get some more analysis on this. Johnson Derry runs the research department at Suntra Investment Bank in the Kenyan capital, Nairobi. Joins us now live in a studio. Mr. Derry, last year's draft of the VAT bill was estimated to raise about 5 or so billion shillings, roughly $58 million. Based on the draft you've seen for the same law this year, is that figure still valid?
Well, it's a tough call to make, because there are certain things that happen when you've got you know, when they're modeling these things, because behaviors assumed to remain the same, but behavior changes when tax rates change, because when you know, the citizenry you know, when they are met with new taxes, then the behavior, the way their spending patterns change, and that might mean that then you stop buying processed milk and maybe buy milk straight from the cow, and government loses its revenue. So it's a tough call to make. Maybe they might do it the first year, but the next couple of years you might see changes.
Indeed. Beyond, however, the numbers and the potential revenue raising, difficult to model as that may be, what are the real administrative changes that this VAT bill will bring to the table?
Well, it's supposed to simplify things, and in so doing make tax administration a bit cheaper, easier, less time consuming, and also because I think the cash flow issues that are raised in the bill, for example, VAT refunds, maybe that is to minimize those. So generally speaking, it's supposed to, amongst other things, save on time and you know, other cost in the administration of tax generally.
Let's move on to comparison. Some might say is an apples and oranges comparison here. Last year in the budget, the Kenyan government also introduced withholding taxes on trading shares for oil companies in Kenya. And that, of course, ran into several implementation hurdles. It's never really taken off the ground. Therefore, on that basis, what is the risk that this VAT bill may just turn out to be another dud tax?
I'm also reminded of the other tax they slapped on beer some time back, and they had to reverse it after some time because revenues from beer sales had collapsed. So for me, it wouldn't be so much of an implementation problem. What I'm more concerned about is behavioral change, because at the end of the day, it will impact on the spending power of the ordinary mwananchi, and adjustments. Some people tend to move into the black market, others will just reduce consumption, and all might end up being revenue neutral.
Indeed. Just to translate for audiences who are not Swahili speakers, ordinary mwananchi essentially means ordinary citizen. Finally, of course, Nderi, one key trend in the patterns of fiscal ratios for the government, government expenditure as a percentage of GDP, 47.4% last year, but revenues have never gone beyond 30%. Obviously, that's not sustainable. Where's the breaking point for the Kenyan government?
Well, if you've come across Carmen Reinhardt's and Kenneth Rogoff's, this time it's different analysis, where they kept saying that maybe you talk about 90%, but if you go back to, say, the tequila crisis, and you look at Mexico and the other Latin American countries, I think that was about 51%. We've even seen, I can't remember if it's Lithuania or Latvia, where they weren't able to access a market with a debt to GDP level of 20%. So for when it becomes, it's really an issue of investors' perception, where the market determines that your fiscal plan is not sustainable, and the unfortunate thing is that withdrawal at that point is sudden, like when Greece just lost the market on one particular day, and all of a sudden they couldn't raise any money. I think the answer then, the best answer anyone can give is that you'll borrow until when you can't. Indeed. So that's really the breaking point. When it's really a psychological issue, and it differs from country to country, depending on which market the country is trying to tap.
We'll have to leave it there for the time being. Johnson Derry, Head of Research at Suntra Investment Bank, thank you so much for your time this Friday evening. Now, let's make a quick run through the market here for you. Of course, the EGX in Egypt is closed, this being a Friday. Some fairly interesting trends happening over there from Wednesday through to Thursday. Gains on the order of about 7+ percentage points. Nigeria, the all-share market, the all-share index rather, up 1.21 percentage points on the day. The all-share index in South Africa in the red, down by 1.4 percentage points. And the 20-share index in Nairobi reversing some of the losses we saw in earlier trading sessions, ending the day higher by a quarter. The Egyptian market, as I mentioned earlier, closed, this being a Friday. That's your business for you this week. We'll do this again on Monday.